You are listening to The Age of Cryptocurrency by Paul Vigna and Michael J. Casey. Think about it this way. What transforms simple paper into something valuable enough to trade for your morning coffee? The answer isn't complicated, but it might surprise you. Currency functions solely because communities collectively agree it possesses worth as a trading medium. Throughout history, different societies have embraced wildly different monetary systems. Ancient civilizations minted coins from precious metals like gold and silver, which carried inherent worth. Yet even these worked only because people believed in their value. Trade with cultures that didn't prize these metals. Your shiny coins became worthless rocks. The Pacific island of Yap offers a fascinating example. Residents there conducted business using massive stone discs called fei. These weren't pocket change, some weighed several tons. Often, ownership simply transferred without physically moving the stones. European visitors found this baffling, but it worked perfectly because the Yapese community trusted the system. Trust forms the foundation of every monetary system. Without it, currencies collapse spectacularly. Germany's Weimar Republic discovered this harsh reality in the 1920s. Facing crushing post-war debts, they printed endless amounts of new currency. Citizens eventually used banknotes as wallpaper because actual wallpaper cost more. This hyperinflation destroyed public confidence and brought economic chaos. Enter Bitcoin, the digital phenomenon that's reshaping how we think about money itself. Many struggle to accept Bitcoin as legitimate currency because it lacks physical form. Yet it operates on the same fundamental principle as traditional money, collective trust in its value. Early skepticism has gradually given way to widespread acceptance. Bitcoin's price surge tells this story powerfully. During the first quarter of 2013, individual Bitcoin values rocketed from $129 to $1,165, an astronomical 800% increase reflecting growing public confidence. Unlike government-issued currencies, Bitcoin operates without central banking authority. Instead, new Bitcoins enter circulation through a process called mining, which prevents uncontrolled creation that typically leads to inflation. The first real-world Bitcoin transaction perfectly illustrates this evolution. Back in 2010, Florida programmer Laszlo Hanieks owned roughly half of all existing Bitcoins worldwide. Since nobody accepted digital currency then, he orchestrated an unusual deal. Through Bitcoin forums, he found someone willing to purchase 2 Papa John's pizzas with a credit card in exchange for 10,000 Bitcoins, worth approximately $41 at the time. That pizza purchase made history as the first tangible Bitcoin transaction. By 2014, those same 10,000 Bitcoins had skyrocketed to roughly $5 million in value. Talk about expensive pizza. Bitcoin creation mirrors gold mining in fascinating ways. Instead of pickaxes and shovels, computers mine Bitcoins by solving incredibly complex mathematical equations. These calculations require massive computational power. Successfully solving problems earns Bitcoin rewards, while new challenges continuously emerge. Faster computers improve your chances of earning rewards. However, there's a built-in scarcity mechanism. Bitcoin rewards halve every 4 years, creating urgency among miners. The system caps total Bitcoin production at 21 million units, with estimates suggesting the final Bitcoin will emerge around 2040. Every newly mined Bitcoin updates the blockchain, essentially a permanent public ledger recording every transaction ever made within the network. Think of it as a massive accounting system that everyone can access and verify, ensuring no Bitcoin gets spent multiple times. Each Bitcoin owner receives a unique encrypted address within the network, similar to a bank account number. When you purchase something with Bitcoin, the network registers a transfer from your address to the merchant's address. This transparent system maintains accuracy without requiring traditional banking intermediaries. Here, where Bitcoin becomes revolutionary, it eliminates middlemen who traditionally profit from financial transactions. Throughout history, institutions like banks have charged fees for facilitating money transfers. The medieval Medici family built enormous wealth and influence by serving as intermediaries between savers and borrowers, essentially inventing modern banking. Today's banking system wields tremendous power, influencing politics through lobbying and charging fees that get passed to consumers. Many retailers refuse credit cards for small purchases because transaction fees make them unprofitable. Bitcoin's decentralized structure removes these costly intermediaries. Transactions happen directly between parties, making transfers both cheaper and faster. While credit card payments can take days to reach merchants, Bitcoin transactions complete almost instantly. Anonymity represents another crucial Bitcoin feature. The term cryptocurrency literally means hidden currency. Bitcoin protects user identities by keeping personal information secret during transactions. This privacy feature appeals to many users, but also creates potential problems. The Bitcoin revolution has attracted massive investment and innovation. Between April 2013 and April 2014, over $1 billion flowed into specialized mining equipment. These supercomputers operate roughly 3 million times faster than early mining hardware. Manufacturing demand for these machines often exceeds supply capacity. Some experts worry that continued expansion might trigger environmental disasters due to enormous electricity consumption. However, investment continues pouring in as entrepreneurs recognize Bitcoin's potential. Innovation hubs have emerged worldwide, fostering Bitcoin-related development. San Francisco's 20 Mission, founded in 2012, provides workspace where young entrepreneurs develop Bitcoin applications. Projects like Made Safe, which allows users to rent unused disk space across decentralized networks, and ZeroBlock, an app tracking Bitcoin prices, originated from such communities. Venture capital investment reflects growing confidence in cryptocurrency projects. CoinDesk surveys show Bitcoin-related company funding exploded from $2 million in 2012 to $88 million in 2013. Bitcoin offers tremendous potential for global financial inclusion. Approximately 2.5 billion people worldwide lack access to banking services, limiting their economic opportunities. Bitcoin could transform this landscape. Consider Fatima, a mother of 5 living in a Mali refugee camp. Mali ranks among the world's poorest nations. Her husband works in Ivory Coast, sending cash home through unreliable channels where money often disappears en route. With smartphones and Bitcoin, they could transfer money directly without banks or institutions taking cuts. Bitcoin also empowers women in restrictive societies. Parisa Ahmadi, a young Afghan woman, participated in Film Annex's program paying filmmakers and bloggers for content creation. Since Afghan women typically cannot open bank accounts, Film Annex paid Ahmadi in Bitcoin. She used her earnings to purchase a laptop through an e-commerce site accepting Bitcoin payments. However, Bitcoin faces significant challenges. Software vulnerabilities create price volatility that would be catastrophic for traditional currencies. On February 10, 2014, a software bug at MT. Gox Exchange allowed fake transactions and unwarranted payments. When hackers exploited this vulnerability, MT. Gox collapsed and Bitcoin prices plummeted from $703 to $535 in a single day. Bitcoin's distributed network structure makes regulation extremely difficult. Every network point connects to all others, distributing information across the entire system. This design makes shutdown practically impossible, since there's no central authority to target with legal action. Unfortunately, this same feature enables criminal activity. Anonymous marketplaces like Silk Road use Bitcoin for illegal drug sales and even more serious crimes. Since buyer and seller identities remain hidden, law enforcement struggles to investigate such activities. Despite these challenges, Bitcoin represents a fundamental shift in how we conceptualize and use money. Anything can function as currency when people agree it has value. Bitcoin has existed for only a few years, yet industry growth and public trust continue expanding rapidly. The potential for Bitcoin to revolutionize global economics by eliminating intermediaries and providing anonymity remains enormous. While current volatility and criminal applications present serious concerns, cryptocurrencies undoubtedly represent our financial future. Found these insights valuable? Hit like and subscribe for book summaries that could transform your thinking. The purchase link for The Age of Cryptocurrency is waiting in the description, and we're curious, which of these concepts resonated most with you? Drop a comment below